A single acre in Palo Alto sells for more than a house in most of America, and the reason isn't what you think. Here's the trick: land doesn't have intrinsic value. It has assigned value. And in Silicon Valley, that assignment was made by a very specific chain of decisions, starting in the 1950s when nobody thought this stretch of Santa Clara County was worth anything at all. After World War II ended, defense contractors needed room to build. Lockheed, Westinghouse, and others planted factories in the valley because land was cheap, labor was available, and the climate didn't freeze your equipment. Suddenly, a peach orchard had a new purpose. But what really happened next? William Shockley moved to Mountain View in 1956 and started Shockley Semiconductor. He invented the transistor. 8 of his employees left and founded Fairchild Semiconductor nearby. Then those employees left and founded Intel, AMD, and a dozen others. The cash started flowing in. When money flows into a region, the first thing that happens is this: workers need housing, developers buy farmland and build subdivisions, prices start climbing. But here's where the compounding begins. Why does the climb accelerate? Because now those tech workers are wealthy. They're earning salaries that dwarf national averages. A junior engineer in 1970 could earn what a doctor made elsewhere. That purchasing power gets bid into the price of every home. And here's the trick: once prices rise, property taxes rise, and that tax base funds schools. Better schools attract more families need more homes, developers want to build, but now there's less land left. Supply tightens, prices spike, and the companies that started it all, they're now worth billions, they need to expand, so they buy more land themselves. By the 1980s, Apple, Intel, and HP were major landholders. They weren't just competing for engineers, they were competing for real estate. Every square foot mattered. A building on Sand Hill Road could house a venture capital firm that deployed billions of dollars. Location became inseparable from economic power. Now the real mechanism: venture capital. Startups needed to be near Sand Hill Road to pitch investors. Investors needed to be near Stanford and the engineering talent pool. Engineers wanted to be near the jobs, so everyone converged on the same small geographic area. Demand compressed into scarcity. Here's the economic principle: when 3 critical resources, capital, talent, and infrastructure, cluster in one place, the cost of being in that place explodes. You can't move the Stanford Engineering School. You can't move the Sand Hill Road venture firms. So land prices become the cost of participation . By the 1990s dot-com boom, an acre in Palo Alto hit $10 million. Companies weren't buying land to farm it or to live on it. They were buying it as a signal . A physical address on Sand Hill Road meant you were legitimate. It meant you could attract investors. It meant you could hire. The land became currency. Gold is expensive because it's rare and universally desired. Silicon Valley land is expensive for almost the same reason, but the desire isn't biological. It's structural . The entire innovation economy is built on proximity. Move 30 miles away and you're out of the network. Let's trace the cash for a specific parcel. A plot in Mountain View bought for $50,000 in 1965, sold for $500,000 in 1985. By 2000, that same plot was worth $5 million. Today, it's worth closer to $30 million. That's not inflation. That's structural economic change captured in real estate. The companies understood this. Apple didn't just build its first campus in Cupertino, it bought the land knowing it would appreciate. Microsoft, Google, Facebook, they all did the same. Real estate became part of the balance sheet. And here's the trick: as land values rose, only the richest companies could afford to expand. Smaller startups got squeezed out. They couldn't afford the rent, so they moved to San Francisco, then Oakland, then farther. But the network effect pulled them back. Investors, customers, and talent were still on Sand Hill Road, so prices climbed everywhere in the Bay Area, following the same logic. This created a feedback loop. High land prices meant high rents. High rents meant companies had to pay workers more. Higher wages meant more spending in the local economy. More spending meant more demand for commercial and residential space. More demand meant higher prices. The wheel kept spinning. Environmental regulations also tightened. California restricted sprawl. You couldn't just build outward anymore, so the only direction was up, and up meant denser, more expensive development. Scarcity became engineered. The value only climbed higher. So why is Silicon Valley land more expensive than gold per ounce? Because gold sits in a vault and does nothing. Silicon Valley land asterisk produces value asterisk. Every square foot generates economic activity, attracts talent, houses innovation. The price reflects not the physical dirt, but the asterisk probability of wealth creation asterisk attached to that location. That assignment of value, the story of how a peach orchard became the most expensive real estate on earth, didn't happen by accident. It was the result of defense spending, transistor invention, venture capital concentration, talent clustering, and regulatory constraints all compressing into one valley. The land costs what it costs because the system demands it. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe for the next explanation of where the money actually went. There's a new economic mystery every week. This video is for educational and informational purposes only and is not financial advice. Always do your own research.